All right, I think we're ready to get started. Thank you everyone for joining, and thank you to all of our panelists for agreeing to come today. This is the final webinar of our Grounded series, so 4 of 4, and we've had an amazing turnout for all our webinars and great level of engagement, and very proud of what we've done in this webinar series and the speakers that we've been able to get on, and sort of the attention that the club has gotten over the last 4 or 5 weeks. So my name is Alex, and I'm the chair of the Monash Energy Club, and I will be today's host. And today's webinar focuses on investment in the energy industry, in particular transitioning that energy industry, and where it's most needed, and what is sort of curtailing investment in some areas, or some of the challenges that we may have to come over to get more investment in the industry. So just like to first of all state that while we're very glad of having our 3 panelists here from 3 very respectable organisations, the opinions that they say today will be of their own, not of their employer. Just some sort of house rules, just to make sure that that's well known. So I'll get on board with introducing our panelists. First of all, we have Bobby Vidakovic. Bobby, if you could, yeah, thank you. So Bobby Vidakovic is the director of the Clean Futures team at the CEFC, which is the Clean Energy Finance Corporation. And this has a particular focus on unlocking investment and development opportunities in grid augmentation. So this extends from transmission, interconnectors and renewable energy zones to hydro and even grid battery storage. Bobby has had experience with finance for over 20 years and has been in roles in energy investment, particularly for the last 11. Next, Andrew Harpham. So Andrew's work in the energy sector focuses on understanding and forecasting outcomes in wholesale energy markets. This work has been for a number of different purposes, including retail price regulation, assessing energy security outcomes, and advising on energy market reform and restructuring. Andrew's worked at Frontier Economics for the past 15 years. Lastly, we have Angela MacDonald-Smith. Angela works at the Australian Financial Review for the last 10 years and writes on the resources industry with a focus on energy, including gas, oil, electricity, and renewables. She has also written for various international publications, including Bloomberg and the Dow Jones. So thank you very much for all of you for attending today. As the same with the last 3 webinars, we are wanting a lot of audience participation and questions throughout. So please use the Q&A function for any question that you have, and myself or my team will try and get that question answered. The way it'll work is that you'll be given permission to unmute yourself, and then you'll be asking your question directly to the panelists. And this is also a way for getting a little bit of dialogue between the audience and the panelists. So if you have a follow-up question, just let that be known. You can also vote and comment on what your favourite question is, so that we can see that more clearly. If, however, you would prefer to stay muted, then just let that be known, and we'll ask your question on your behalf. Now, I'll jump straight into our first question. As this is around energy investment, I think it's first of all just useful to get a sort of broad picture idea of what the state is of investment today in renewables and gas, and in really the entire energy market. So I might first off start with asking Bobby this question. Would you be able to provide a sort of big picture image of what energy investment is like today?
Right, yeah, thanks, Alex, and a pleasure to be participating as part of the event, so thank you for the invitation. I guess the state of the market at the moment is really driven by, or has been driven in past years by, the renewable energy target, which was satisfied in the last 12 to 18 months. So that really drove significant amount of investment in solar and wind generation. And I guess since fulfilment of the RET, we've seen what is a fairly significant sort of change in terms of the rate of pace of new wind and solar activity. There is still some gas activity, I guess not as profound as the move in wind and solar. And I guess looking sort of at the current state of play, the one of the key factors that's driving the appetite for investors in renewable projects is the ability to connect. Grid connection is increasingly a big factor, as well as understanding sort of what the long-term proposition is in the absence of the RET.
Right, okay. And are we sort of seeing more activity investment in renewables, or is it sort of dwindling a little bit?
Clean Energy Council have recently published information in terms of sort of where the state of the market is, and there is, in the last 12 months, a significant decrease in utility scale wind and solar projects. Distributed energy is still seeing strong application and strong uptake. So if you look at AEMO's integrated system plan, distributed solar still has a significant forecast in terms of going forward, and we would continue to expect to see that not just from residential, but increasingly through commercial uptake of solar projects.
Thank you. And you mentioned the renewable energy target. So that was a big impetus for investment into the renewable grid. That was met, I think, late last year or early this year. And we haven't yet seen that be updated to sort of push along renewables further. Do we sort of need to see an update to that to see greater investment in renewables? Or is renewables sort of this now unstoppable force that doesn't really need to be pushed any harder?
It's a really good question. I think that comes down to the rate of transition in terms of if there was additional policy incentive to encourage renewables, then absolutely the rate of deployment would increase. But what we are seeing, even in the absence of the RET, is projects are still committing. So whilst not at the same levels as they were 12 months to 2 years ago, there's been recent announcements, for example, a few large-scale wind and solar projects in Queensland that'll be supported by either the government-owned corporations, so Stanwell and CS, or even, for example, BHP committing to supporting I think it was a wind generator, and that capacity or that generation will be firmed through arrangements with CleanCo. So I think the corporate initiatives and the move in the business world in terms of wanting to meet their own ESG objectives will help drive appetite for offtake from some of these renewable projects. So I don't necessarily expect that in the absence of a RET that we'll see deployment or investment in renewables to drop off. But it's really a factor of how strong is the demand, and I've mentioned some of those factors there. And the other one is just technology in terms of the turbines. So for wind projects, turbines are getting bigger and more efficient, allowing them to generate at a lower cost of energy. And those increases in technology will drive those lower costs, which will allow further deployment of this type of technology.
All right, thank you. And in terms of gas markets, I might go to you, Andrew, because you've got quite a big focus on Frontier Economics on gas. How have we seen the gas market sort of grow or change in terms of the transition?
Yeah, look, I think it's fair to say it's been a difficult 10 years for the gas sector. I think it's probably been a difficult 10 years for the electricity sector as well in a lot of ways. There has been an enormous boom in LNG investment in Australia. So Australia is now sort of the biggest or sort of second largest exporter of LNG. So that's happened in Eastern Australia and also Western Australia, the Northern Territory. And essentially, if we think about Eastern Australia, the overwhelming majority of the investment we've seen in the gas sector over the last decade has been investment in the gas fields to produce the gas, and then liquefaction plant to turn that gas into LNG and to ship it to Japan and China and Korea and all those places. I guess the sort of common complaint of the manufacturing sector in particular, but I guess gas buyers generally in Eastern Australia, is that there hasn't been equivalent investment to supply the domestic market. And in fact, the complaint has been that our gas in Eastern Australia in particular is being sent overseas through these shiny new LNG plant to overseas customers rather than being supplied to domestic customers. And certainly that is the case. I mean, it's sort of clear that it's more difficult for a domestic buyer to get a contract, a gas supply contract now than it would have been 10 years ago, when prices have gone up a lot. The sort of the vexing question is, why has that happened? And depending on who you ask, you get different answers. The gas industry will say that there's a number of policy decisions that have been made that have made their investment decisions to supply the domestic market very difficult. So, principally bans on investing in unconventional gas, so coal seam methane or tight gas. So gas that requires fracking in particular to produce. So various state governments have made that more difficult. And generally, I think the gas producers would also say that often their sort of foundation customer will be a gas-fired generator, but the changes in the electricity sector have meant that there's been no substantial investment in gas-fired electricity for 10 years. So they've struggled to find one of those foundation customers to get a new investment off the ground. If you ask the gas buyers, a lot of them would say none of that's true. There's plenty of gas that has been developed. It's just that it's going overseas. What's really happening here is that the gas producers are, I guess they would probably say, tacitly colluding to keep prices to domestic consumers higher.
Okay.
The truth is probably a combination of both, I'd say.
Right. And we saw that the Commonwealth Government was considering a gas aid recovery for COVID, and that some of those moratoria might be lifted. I assume that would bode well for gas investment domestically.
Yes, I think so. So I mean, look, certainly there are a number of businesses who are keen to invest, and there's a number of projects that look promising. So Santos has a big project in New South Wales. There is, reported to be a great deal of gas onshore in Victoria that could be produced relatively cheaply. You never know for sure with gas, how economic it's going to be, but certainly you would expect to see new investment if those moratoria or those projects were to gain planning approval, and that would be to the benefit of gas consumers. It's unlikely, I would say, that we go back to the days when gas was, $4 a gigajoule, sort of now $8 to $10 a gigajoule, because the estimates of the cost of producing from these fields is still relatively high. But yes, certainly I think that would be of great assistance to gas buyers, but it's a long path. The path to sort of exploring, proving up the gas, developing the project, takes a number of years. Santos is probably the most well advanced, but they're still a few years away from full scale production from Gunnedah. So I'd say there's still a few tough years for gas buyers in Eastern Australia at least. And I think that's why we're seeing these. There's a number of proposals to import LNG into Eastern Australia, which on the face of it is a bit perplexing that we're both exporting LNG and then importing LNG. But nevertheless, there are people seriously considering spending a lot of money building a plant to import LNG, which may be a shorter term solution.
Yeah. If we're not sort of expected to go back to those cheap gas prices that we used to have, what are the implications of that for the transition? So gas is always touted as the being complementary to renewables, to firm up the grid and to be used as a peaking energy source. If we're not going back to those cheap gas prices, then are we likely to see this transition to sort of become like uneconomical?
No, I mean, I think, you know, there's a number of different ways that we can firm up renewables. I mean, you're absolutely right. You know, for a long time, gas was seen as the obvious choice. It's cleaner than coal. It's more flexible than coal. You can turn it on and off more quickly. For peaking duty, it's cheaper than coal, but it's not the only solution. You know, there are other forms of storage, whether it's hydro or battery storage. But to be frank, gas is still a pretty attractive choice. I mean, batteries tend to give you pretty short-term storage, whereas you know, gas generators you could run for days on end if you have a solar drought and a wind drought and you need the energy. We don't actually use, if you wanted to run gas generators that way, you don't actually need huge amounts of gas, certainly compared to the amount of gas we have in Eastern Australia. So I don't think it's going to be a case of us not having enough gas available to run generators in that way. I think the real issue at the moment is that it would be very difficult, I think, to establish the case to build or to invest significantly in gas power generation at the moment. In my mind, there's sort of so much uncertainty about future policy direction for the NEM. I'd certainly be a bit wary about spending $1 billion on a gas-fired power station that's going to be operating for the next 25 years. And look, to be fair, there's also technology uncertainty. You know, it may be that the cost of batteries come down so quickly that even with all the policy certainty in the world, you're not sure whether your gas-fired power station will be stranded or not. But I think the problem for gas-fired investment at the moment, I don't think is principally about the supply of gas. I think it's principally about uncertainty in the electricity market. I think where gas is a problem is really for manufacturers who tend to use a lot more of it and need a sort of regular supply of gas.
Yeah. All right. And Angela, there's a big focus in your writings on the gas industry in Australia. And just from a quick glimpse in the past, maybe stories that have come out in the last month, I guess stories that are promising towards the gas industry are few and far between in terms of you know, things closing down or they've been hit hard by COVID. What is your sort of opinion of how the gas industry is doing at the moment and sort of its longevity?
I think you've got to sort of look at the export side for gas, so the LNG side, and then there's the domestic gas side. So obviously they're both connected, and you know, some of the producers in one overlap with the other. Yeah, the LNG industry and the oil and gas industry in general has had a really hard time this year. We saw this massive plunge in collapse in crude oil prices in March, and that, you know, was a combination of oversupply in the oil industry and also just the collapse in demand because of COVID. And that's really just destroyed the business case at the moment for further investment in the LNG sector specifically. So there's still quite a good demand outlook, it looks like, for export gas, but it's just not realistic at current prices, and it's not viable. And Australia is, in any case, a high cost destination, a high cost location for investment and operations. So I think when you look at investment in the export LNG side, it's pretty much on hold at the moment. I think if you look at the major players in that area, then no one's really talking about further investment in LNG until next year, or at least beyond that potentially. And then you have to look at the type of investment that we've got there as well. It's quite interesting because, you know, we've had this massive build of LNG processing infrastructure around around the country on both sides of the country. And now we have to make the most of that. So we don't need any more LNG processing infrastructure, but we still need heavy investment in the gas fields that will supply it. And I think that's, if you look at the LNG sector anyway, then that's where, we are probably going to see more investment, maybe not this year, maybe not next year, but just the investment in whether it's offshore fields off Western Australia or in Queensland onshore fields, just to keep the plants running, the LNG plants running, to keep them full, just to make the most of the $200 billion odd that we've seen invested in that sector in the last 10 years. And then you've got the domestic gas side, as Andrew was just explaining. It's pretty difficult to invest in gas-fired power generation at the moment. Although I think if you speak to pretty much anyone in the industry, they see that there will be a place for that. It is more difficult now. Obviously, battery storage, pumped hydro, etc., have made leaps forward in terms of cost competitiveness. But yes, gas power is still the answer, I think, very much for that complementary role to complement renewables. But yes, there's an issue around wholesale prices of electricity being so low at the moment. It doesn't really stimulate any investment at the moment in new power, apart from renewables. So there's an issue around that. So we're going to have to see how that will be resolved. I think the bigger problem for gas domestically is for those manufacturers that have relied on $3 or $4 gas. That's what their businesses are built on. There are those sorts of prices and contracts underpin thousands of jobs in manufacturing on the East Coast. But gas is just not going to be available at that price any longer. I think even without the Queensland LNG exports, my understanding is that those prices are behind us. So that's going to be a real problem for the domestic gas sector.
So if the manufacturing side is so important for Australia, and we don't have those cheap gas prices anymore, is it going to end up with the government sort of having to subsidise those industries?
Well, that's certainly the way it looks to be heading at the moment, particularly with the gas fueled recovery that you talked about, and the National COVID Coordination Task Force coming up with this sort of roadmap to try to return gas prices to $6, if not $4. Prices of $4 or $6. I mean, you speak to any of the producers, and they won't invest in new projects at that price. It's just too risky, too much risk capital involved. They just can't make the returns. So to meet that gap, then yes, it looks as if it might be heading down the way of some sort of government support, some sort of intervention, some sort of measures that close the gap between what manufacturers insist that they need for their plants to stay open and the price that is required for gas producers to invest in new supply. At the moment, there's quite a bit of gap between that. We're talking about, say, $4 a gigajoule that manufacturers are saying that they need, and perhaps $7 or $8 on the other side. So that's quite a gap there.
Cheers, thank you, Angela. I'll move on to more of the sort of renewable side of things and the infrastructure sort of side of things, because based on my knowledge, I think one of the problems, at least, that comes from renewables is the construction of a solar plant, and then those solar plants or wind plants not being able to actually connect to the grid. Who in the past has been paying for the connection of these wind and solar farms, and are they still wanting to? Are those parties still investing, or is it sort of shifting a little bit? I'll get Bobby to take that question if you don't mind.
Right, thanks, Alex. And a very topical one in the context of renewable deployment at the moment. To answer your question specifically around who pays, connection is generally something that's paid for by the generator. So a wind or solar farm would be paying for its connection costs. But there's a question around, well, what about the transmission to get out to those areas? which is generally a regulated asset. So in that case, it would be a consumer cost. But what generators have been doing in the last, well, for quite a while now, is to build where there is limited augmentation of the existing network and connect into what is generally remote parts of the country, where generation capacity is at its highest, but does face significant potential curtailment and losses or marginal loss factors to be able to actually export that generation. So what that's actually resulted in has been degrees of curtailment that have been imposed by AEMO or others, as well as larger losses that have been incurred by these generators in particularly remote areas. Now, to be able to overcome that, generators have, through development activity, have been adapting to that environment and knowing that building out on a stringy line out west in the eastern market does come at a cost that was probably not appreciated going back a few years ago. And grid is probably, I'd say, if not the biggest factor, one of the biggest factors that generators are taking into account to accommodate ways in which they can overcome some of these the risks that they've been facing over the last few years.
Thank you. And how are sort of so the ISP that you mentioned has a big focus on those renewable energy zones, the REZs. Would you be able to briefly describe what actually is a renewable energy zone and their role in perhaps the infrastructure and the grid connection?
Yeah, absolutely. Yeah, so REZs, it's an interesting one as well. I guess each REZ is very specific, very bespoke. To date, there hasn't really been a large-scale REZ that's been deployed in Australia. So the market is really testing what these look like in terms of the way they're delivered, the commercial framework, the parties that are involved, and ultimately the developers that need to actually undertake the activity to actually bring one of these to market. But ultimately, the REZs have been conceived really as an area whereby there's strong levels of renewable resource, whether that be wind, solar, hydro, etc., to then try and deliver what is a scale-efficient solution. Because in its own right, if, for example, a 100 megawatt solar farm was to connect into a 500 kV line, it just wouldn't make sense. The connection costs would be, at a high level, sort of $80 million plus to connect into such high voltage. So REZs really, I think, look to send a signal to market to collaborate, which is quite an interesting concept in itself, because generators typically are competitive by nature, whereby the ability to coordinate hasn't been something that's been undertaken in the past, or at least in limited circumstances. However, the scale efficiencies in terms of building at scale, the benefits associated with being able to position in a location which otherwise wasn't available because it opens up new areas, which should hopefully overcome or at least reduce the risks associated with marginal loss factors and that curtailment. Two factors that really underpin, and increasingly so in recent times, underpin the investment proposition for these projects.
Right. And do we sort of see, it's a bit of a chicken and egg, do we sort of see renewable energy zones set up and that drives investment from generators into those areas? Or are we putting renewable energy zones into areas where there's already a great amount of generation?
That depends. It really is mixed. At least those zones that have been identified by AEMO include completely new areas where there's limited existing renewable capacity, whereas in other areas there might be incumbent generation, both renewables and, say, coal, for example. where it's being positioned. So the benefit is that to the extent that these zones are in existing areas where there is retirement, there's the ability to help transition some of those assets into new assets. And that should also deliver some savings in terms of being able to fully or continue to utilise existing assets on the ground. It really comes down to each res is very different, and the way they come to market will also vary. So, for example, there might be state-led initiatives, and we're seeing that increase, particularly over the last 6 or so months, whereby New South Wales government has announced the Central West Orana res, as well as the New England res, and have committed capital to the development of those projects. And more recently, in the last month, the Queensland government has also announced funding for 3 reses or multiple reses in 3 regions. So there's the state-led initiatives where they've got specific targets to meet. Victoria and other states are also active, but there's also it's important to note too that some of the other activities in reses might be led by network operators who see significant interest inquiries, connection inquiry interest in a particular area, and or private developers or generators, whereby they might align with 2 or 3 other generators in the region and say, look, on a standalone basis, this economic proposition for our project doesn't work, but let's band together to create a solution to be able to make it work.
And are they sort of, I assume they're not prohibitively expensive, but are they also not exactly, in terms of the infrastructure needed to connect to, say, 2 or 3 generators, is this sort of scale of investment needed by these generators larger than sort of maybe feasible for some generators, or is it sort of a small investment?
If it was a small investment, I'd say that generators would typically just go down the path where they do it alone and avoid the complexities or potential differences of views and opinions associated with what that infrastructure and design should look like. So it generally is at scale. The scale will really depend on where that region is. So, for example, if there's shared network infrastructure that needs to be augmented to accommodate the generators, then that's generally at high scale, because usually the shared network is at higher voltages. But there's also reses, for example, that have been touted that rather than augmenting the existing shared network, it'll just be a spur line that is effectively just an extension from an existing point out maybe 30, 50 kilometres to collect multiple projects. So there might be a substation or a hub, and then that spokes out to collect the individual generators. Those ones should be far easier to deliver, just given the complexity around the regulatory framework to be able to make that work.
Okay. And I would just add that we're answering questions as we go along. So if you're in the audience and waiting for your chance, put your questions in now, and I'll try and get to them whenever I can. I'd like to move on to a bit more about policy, and we spoke about the renewable energy target and the impact that had. At the moment in Australia, we've got the Emissions Reduction Fund and the Safeguard Mechanism as a means to, I guess, limit or control the emissions coming from major emitters in Australia. I think if you asked most people in universities and for myself, that will need a step up from this safeguard mechanism at some point to really curtail those emissions, something like a carbon tax or an emissions trading scheme. Hypothetically, when this does come in, what will the impact of that be on some of Australia's largest emitters, like the gas industry and the coal industry? Will it be favouring one source of energy more than the other? Will it be disastrous for the energy grid? Andrew, I might go to you, because I know Frontier Economics has quite a lot of history in sort of emissions trading schemes and baseline mechanisms.
Yeah, sure. So, I mean, I think, in a sense, I'd agree with you that if we want to continue to drive lower emissions, you would think we need some kind of more aggressive action, whether that's a carbon tax or whatever other policy. I guess I have some hesitation saying that because, I mean, if you see what is happening to Australia's emissions in the electricity sector anyway, and what is forecast to happen, in fact, emissions are forecast to fall sort of enormously in any case, simply because all of the investment that we've seen over the last 10 to 15 years essentially has been renewables. We haven't built a coal-fired power station in the NEM since 2004. We built one in WA maybe 12 years ago or 10 years ago, I can't remember. But it's been years since we built a coal-fired power station. We've actually not really built much gas-fired generation in the last decade either. And we have seen significant retirement of coal-fired power station, and that's going to continue over the next 2 decades. So just retiring the existing coal-fired power stations and the fact that it seems unlikely, not impossible, but unlikely that we will build another coal-fired power station, we are going to see a lot of reduction in emissions in any case, mostly just because of the economics. I mean, it's not entirely because of the economics, because, I mean, to be frank, building a new coal-fired power station today, if there was never going to be a carbon price, would be a wonderful economic decision. You'd make a lot of money out of it, but no one's prepared to do it because they're not prepared to take the risk that there is going to be a carbon price in the future. So whether you actually need the carbon price or just the threat of a carbon price, I guess, is a question we don't need to go into too much. But either way, I think you're right. I mean, the industry in Australia that is producing coal for domestic use, I think, is certainly on its way out. On current plans, all the coal-fired power stations are going to be retired basically in the next 30 years. Many of them well before then, and even if we do see 1 or 2 new ones, it's not going to be anything like the scale we've seen to date. Gas is interesting. I mean, you would make the same argument about gas ultimately. I mean, it's cleaner, but it's not clean. It's still emitting. It's still a fossil fuel. The difficulty with gas is that because its use is so distributed, it's a lot more difficult in some ways to manage the emissions. I mean, there is a prospect of carbon capture and storage for coal, but because we're burning gas at thousands of locations, thousands of commercial, industrial, residential facilities around the country, you can't capture the carbon at all of those. So if the sort of distribution and use of gas is going to have a future in a world with zero carbon, then it's not going to be natural gas. You wouldn't think. It's going to be hydrogen. And look, there is good reason to think that ultimately what we'll see is replacement of distributing natural gas for heating, cooking, hot water, etc., will be replaced by distribution of hydrogen. We can still use the existing gas distribution network. And on our estimation, it's probably cheaper to use hydrogen for those uses than to try and shift all of that demand from gas to electricity. You can electrify all of those uses, or many of those uses in principle. So we could all be using electric heating, electric cooking, electric hot water. Commercial and industrial users for the most part could also electrify their current gas use. But to do that, based on sort of current estimates, and of course this is all very uncertain, but based on current estimates, that looks more expensive than to continue to use existing gas infrastructure, the pipelines, but to distribute clean hydrogen. But if we go down that route, of course, that massively increases the need for renewable electricity, because ultimately that hydrogen most likely would be produced through electrolysis, which requires electricity. And if we want it to be clean, zero emissions, we need it to be renewable. So there are sort of pathways that see us getting out of domestic coal and domestic gas use over the next 30 years, but both require enormous investments.
Right, but we're not so much seeing gas companies going towards that clean hydrogen. It's sort of a mixture of clean and steam methane reforming gas. So is hydrogen really still the answer then? If it's going to be made through a mixture of blue and green hydrogen, or just blue or just black?
Yeah, so it's a lot cheaper at the moment to produce hydrogen through steam methane reforming. And so I think a lot of people are looking at that as a way to sort of make the transition more economic. If you believe that carbon capture and storage is feasible, it may also continue to be cost effective to have steam methane reforming with carbon capture and storage, even in the long term, as long as we have gas. But most likely, I would say what will happen is that steam methane reforming will form part of a transition. And look, longer term, if the costs of renewables continue to come down, and as gas becomes presumably increasingly scarce and potentially increasingly expensive, the economics will shift in electrolysis's favour in any case. So all of this is, it's a long way down the path, but even over the last year or two, there's been certainly far more interest in the use of hydrogen than there has been, well, since the last apparent hydrogen boom. We've had a few periods in the past where hydrogen has looked like the way of the future, but certainly there seems to be much more activity and a lot of businesses, both existing sort of gas network businesses, but also existing gas users are looking at hydrogen very seriously, and a number of international economies are looking at hydrogen very seriously. So whether it stacks up economically in the long term is still unknown, but on sort of current estimates of costs, it looks promising, and I think it looks likely to play a role in Australia.
Yeah. Now, I would like to get Bobby's view on hydrogen, but first I'd like to bring it back to the emissions trading scheme and sort of carbon tax question. Angela, you've been in at the AFL for 11 years, so I think you would have just seen you would have seen Rudd's CPRS change to the baseline mechanism, so the safeguard mechanism, and now you would have been seeing the push for something a little bit more progressive. Do you see a future where we have a more stringent carbon tax or an emissions trading scheme, and could this
I think
industries?
it's absolutely necessary. And the interesting thing is that if you talk to the investors in the industry, they all want to see it too. They're actually pricing in a price for carbon in all of their investment decisions. So, whether it's AGL, the biggest emitter in this country, or Woodside, one of the biggest gas exporters, they're all assuming a price on carbon. It would just be very helpful if we actually did have a price on carbon, or at least did have some longer term targets for emissions reduction beyond 2030. I think for everyone, whether it's $30 or $50 or $70 a ton, this is all being sort of locked into the equation when it comes to planning at the moment. So I think it's inevitable that we are going to see something. It's just a real shame that first iteration of the carbon price under the Gillard government, what a disaster that was. If only that could have actually, maybe it was priced too high a price, but I think that was definitely the way to go at that point in time. And I think if you speak to most people in business, they would much rather have seen that persist and in some way then sort of harmonise towards some international price on carbon than the situation we've got at the moment where post 2030, we don't have in Australia any sort of longer term targets for emissions reduction and energy, and we still don't have that sort of overarching policy environment for energy and climate that we really need. That you can see has made so much progress in places like the EU, who've got like these long term targets and long term sort of goals. it's much sort of more certain about where they're heading. They might disagree wildly about how to get there, but they've got all of this long-term target set. And here in Australia, we don't even have, like, for example, the most basic thing, a net zero target for 2050. I think, business, how many times has business called for that? Some of the most polluting businesses have called for that, but we still don't have that. So, yeah. But I do think that everyone's sort of assuming that will happen anyway when you talk to businesses, certainly in terms of public listed companies. I think they think that's the way to go, and it would be much, if only we'd had a smoother path to that, the last iteration of some sort of emissions trading system would have been the National Energy Guarantee. We got so close to that a couple of years ago. And yes, it still all fell away, and now we're sort of back to square one almost. So it's been a bit depressing, I must say, writing about this over the last 10 years and seeing us go around in circles on this, because we nearly got there so many times. But yeah, at the moment we're sort of as far away as ever, it seems, at least in terms of the federal policy to put that all in place.
And now you mentioned that these big emitters are planning for a carbon tax. I guess my worry is that when the carbon tax comes into place, are these companies just going to take it on the chin, or are they just going to pass on that cost to the consumers?
I think everything gets passed on to consumers. You were talking about transmission costs earlier, and the reses and that sort of stuff. That's going to be really interesting as to how it actually turns out in terms of the sharing, just the cost sharing for that, who takes the risks for that. Because, for a lot of these assets, and it will go on the carbon price as well, I mean, the person who pays is actually the consumer or the taxpayer. That's the same person, really. So it all comes down to the energy consumer. I mean, the companies have to take some of the risks, of course, but, it's the consumer that pays at the end of it.
Yeah.
As it should be, I would say. I mean, we're the ones that want the electricity and the gas. Assuming there's no sort of market failure resulting in inefficient prices, I mean, why wouldn't we? Why wouldn't
Yes.
we pay?
All right, and now there's a few questions in the chat about hydrogen again. So I might just go to Bobby about hydrogen, and then we'll address some of the questions. The CEFC has quite a large focus on hydrogen investment, I believe. And I'm interested in your opinion in how this will attach to the grid and its potential really in displacing or decarbonising Australia's gas industry, and what CEFC is actually doing.
Nice. So the CEFC have announced a $300 million, or the government announced a $300 million advancing hydrogen fund, which will ultimately look to support activities in that space. Now, ARENA, which is effectively like a sister entity which provides grants as opposed to the CEFC, which are looking to provide capital with an expectation that it receives its capital back and generates a return, are working together to support hydrogen activity. Much like, I guess, if you look back to sort of 2016 or so, there was a similar process which was undertaken for solar projects, whereby there was very limited solar uptake, utility scale solar uptake at the time. And I guess it's similar in that, I guess the process itself should, number one, focus people's attention on the technology, support price discovery, and even, for example, using that solar analogy, or that example, at the start of that solar round, the solar grants round, to where it ultimately ended up, it was expected that, given the cost of solar, that only 3 to 4 proponents would be successful in terms of the expectation around what sort of grant funding would be needed to support solar projects. In the space of that 12 to 18 month period, solar costs had come down that far that I think the program in the end supported close to a dozen projects. So I guess in that relatively short amount of time, it really came down. In addition to that, the other proponents or participants in that process that were unsuccessful as part of the grant ended up undertaking their activities given the projects were developed and there was value in those projects, and proceeded with building those projects. So similarly, I guess hydrogen is, whilst there is a focus on reduction in cost, given some of the comments made by earlier speakers, I guess the CEFC's activity alongside arenas should hopefully take a similar approach to what was done with solar. Whether we get there or not, and how long it takes actually to get there, are still big question marks. But given the strategic interests specifically from some corporates in Australia, they also might have other reasons and value that they can create from the deployment of hydrogen that otherwise wouldn't be available to, for example, like a standalone generator. So I guess I'm excited to see how that might be deployed in the context of, for example, a RES, whereby RESs, if they are focused on wind and solar and hydro, where hydro isn't available, how hydrogen itself might be able to be used to soak up some of the capacity that would be created from renewables in a particular region.
Okay. And now I've been a bit selfish and asked all the questions, so I'm happy to take some from the audience. So I'll pass over to, I'll also say, Matteo, you've raised your hand, but if you could put your question in the Q&A rather than raising your hand, that would be good, thank you, so that we can get to it. But I'll hand over to my teammates, and if they could find a good question and unmute their respective person, that'd be good, thank you.
Yep, so I'm going to unmute Bernie now. If you could just ask your question about the, pick your question, either maybe the distribution of hydrogen. I'll unmute you now. Yeah, if you could just unmute yourself and ask your question.
Yeah, thanks, Bernie. If he's there, he may not be there.
If not, I'll go to Prakash. You've asked a similar question about hydrogen. If you're...
I am here. I missed what I was being asked.
Oh, pardon me. Bernie, you had a question about the distribution of hydrogen?
Yes. So from what I've seen, it does make sense that it could be distributed on the existing network with methane natural gas, but only diluting to about 10%. And nominal value of that. Could it be any higher than that, or is it dangerous? And yeah, what other methods of distribution are there, or would it just be restricted to driving large fuel cells and buses and trucks? So where is the market for it? What's realistically attainable?
Maybe I could have a go. To start off with. So I mean, I'm not an engineer, but I'll give you my understanding, and we've looked at the economics of this a bit. So I think there's a number of trials that have looked at blending hydrogen with methane, and I mean the trials are still ongoing, so no one's quite sure whether it's 10% that is safe or maybe a 20% blend that is safe, but something around that seems to be safe for use without really changing anybody's appliances or without making any real changes to the gas distribution. But obviously that doesn't get you far down the path of decarbonisation if that's the goal. But it is also supposed to be possible to distribute hydrogen at 100% in the distribution network. But to do that, you need to change people's appliances, because obviously hydrogen burns in a different way to methane, and all these appliances are designed for methane. If we want to use hydrogen, we need to change the appliances, which obviously poses some pretty significant problems with the transition. It has happened before, so there were similar issues. As I understand, it was before I think possibly before I was alive, but we used to use town gas in a lot of distribution networks, which was gas made from coal. And in the transition from town gas to natural gas, similar issues arose. You basically had to change your appliances. So this was a sort of a decades-long plan. And essentially what happened, as I understand it, was for a number of years ahead of the transition, appliances were sold with bits you could take out and replace when the sort of flick over date happened. So it would not be a simple matter to switch the distribution network to hydrogen, but compared with the cost of new appliances, I mean, being able to make use of the sort of existing reticulation networks in places like Melbourne in particular is sort of an enormous cost saving compared with, you know, if we switch to electrification, for instance, we're sort of having to meet all of that demand currently met by gas, but build out the network to be able to achieve that, build out the electricity network, and the cost of that will be enormous. Whereas if we can use the existing gas distribution network to continue to distribute that amount of gas, then there could be significant savings. But look, this is all sort of, you know, trials are happening at the moment. So there's a trial in the UK at a university looking at distributing 100% hydrogen gas to see whether it's safe. I don't know if the theory is that if university students can't break it, it's unbreakable or what, but these trials are underway at the moment.
Geez, thank you, Andrew, and thank you, so Bobby. Sorry, pardon me.
But it's incredibly flammable and explosive and dangerous, and you can't put it in an LPG bottle. You can't distribute it that way. It's very limited, surely.
Well, I mean, look, as I say, I'm not an engineer, but they've decided it's safe enough to distribute it in the UK. I don't know whether it'll ultimately be deemed to be safe enough. And also, I mean, the molecules are also a lot smaller, which can pose problems with leaking. But we'll see, I suppose. Sorry, there's a helicopter outside. It's very exciting at my house at the moment.
That's all right. All right. Well, thank you very much. There's a good question here from Wendy. So, Rachel and Melvin, I might get you to unmute Wendy if that's okay, please. You're good to go, Wendy. Give you a couple of seconds. If not, I'll ask you a question for you. Here we are.
Can you hear me now?
Yep.
Yeah, what I'm interested in is emerging technologies to do with like smart energy technologies, particularly in the digitalisation space, energy management, anything from AI, big data analytics, all that sort of thing. Just interested, potential investment opportunities for Australia. There's some trends that anyone's done on that. I know the CEFC's got an innovation fund, for example.
Yeah, go ahead, Bobby.
Yeah, no, thank you. Thanks, Wendy, for the question. Yeah, so the CEFC's got a specific team that's focused on innovation investments. So that's what that typically is sort of venture style investment opportunities. So that would, for example, be equity alongside, for example, the founders or other investors that are looking to increase the uptake of typically new technologies. And that would include, and there have been past investments whereby we've invested in the Internet of Things type activities, smart meter type activities, or the digitisation activities like you mentioned. So in that space specifically, I guess one of the key things to consider is what is the intellectual property that's being supported and what the prospects are of that, and that'll be sort of one of the key factors or key considerations around investment in those types of startups.
Does that answer your question, Wendy?
Yeah, I'd be interested to know how much money CEFC is going to chuck into that area, though.
Yeah, so if I recall correctly, I think the amount that's been allocated to that space has been something like 200 million. I'd have to confirm that, but it's in that vicinity. But those types of investments are typically smaller. So let's say generally sort of less than 10 million. And so I guess 200 million in that context, would go some way in supporting a number of different parties and their technologies.
Okay, thanks.
Also add that as part of the regulation of the electricity networks in particular, they will be able to access funding essentially to undertake sort of innovative trials. So most of the electricity networks are looking at whether it's different ways of metering, using batteries, sort of looking at customer load in more detail, and essentially that sort of innovative those sort of innovative programs, if approved by the AR, are sort of funded through the tariff surcharges all.
All right. Thank you, Andrew. Thank you, Bobby, and thank you, Wendy. I'll actually sneak in a little question here to Angela. We were touching on COVID's impacts on the oil and gas industry previously, and we actually did a webinar with Shell last semester, right during the bulk of the oil crisis. And one of the things that they mentioned is that oil is used for a lot more than just for the cars on the road. It's used for things like plastics and stuff like that. Do you think we'll start to see these oil companies sort of start to shift towards some of the other commodities that they produce? I know that today there was quite a lot of. Sorry, go ahead.
Well, I was just going to say, if you look at what's happening now, it's pretty interesting what's happened over the last few years. I mean, it was already happening, but COVID has really just accelerated it, I think, and particularly in Europe. If you look at, Shell, BP, Total, Eni, Equinor, that they've all dedicated an increasing part of their budget to these new areas. And okay, so I guess you could say it's still tiny compared to their overall budget, but it is definitely increasing. I think some with companies like Total, for example. I think Total owns one of the biggest solar power companies at the moment. It's got a big battery operation. BP has got some very aggressive targets now for renewable energy use. So the US companies haven't gone nearly as quickly in that direction, I would say, just looking at what's happened this year since this trend has picked up pace. And I would say the Australian companies are sort of somewhere in between the two. You have seen some moves by Woodside and Santos, etc., to move more into new energy areas, but it's very small compared to the European majors. I think we're just going to see more and more of these of this pace and this trend. But what I would also say is that, for oil and gas, there's a distinct change in the tone of the way that these traditional huge oil and gas producers are talking about those further investment in those commodities. So they're talking about accessing sort of near-term resources. You'll see them step away from resources that have very long-dated production expectations. So, resources of like 2040, 2050 and beyond. You'll see like the Totals and the BPs of the world step away from that. And even in the gas area, I think as well. You've heard Woodside talk about this, in that they're focusing on gas projects that can be developed in the relatively short term. We're still talking about 20 or 30 years. These projects do go on for a long time. But there's definitely a thought that by 2050, there won't be much use for gas. It'll have shifted towards hydrogen, these other areas that we're talking about. So I think that's been really interesting over the past few months, how there's been this difference in a change in tone in the way that the traditional oil and gas companies are talking about not just an appetite for investing in new energies, but also their way of thinking about oil and gas and further investment there and how they justify that. I think their investors are obviously asking them to justify it too. They have to answer to their investors. That's a big a big sort of source of pressure for them when they think about future investments, about what their portfolio is going to look like. A lot of the pressure on that is coming from investors.
Yeah, I think so. Woodside had 50% of their shareholders asked them to make a bigger pledge to scope 3 emissions, and I think 43% from Santos. So you think that they're most likely going to be able to sort of placate that audience by making those transitions, or is it?
I think everyone wants to see them making. This comes out most evidently at AGMs, of course, because that's where these activist type resolutions get put forward. But what's evident in the last couple of years is that these are no longer activist resolutions that are only supported by a minority of greedy environmentalists or ethical shareholders. Even these are now resolutions that are getting mainstream support from the main proxy advisors, from the main investors, and I think the companies can't ignore that. They are really having to take that seriously, and that's, I think, been a big driver. That more so than regulation is what's driving them down this path, I think.
Thank you. There's one more question here from Daniel Freed about something that I'm not familiar with, but maybe the panel is. Daniel, if you're there, and if we can unmute Daniel, that'd be great. Thank you.
Yeah, I'm just unmuting you now, Daniel. Yeah, just unmute yourself when you're ready.
Yeah, it's just an open question about the Sun Cable project, which is a project to build a very large solar project, I believe, in the Northern Territories, and then a cable linking that to Singapore. I think it's 3,000 or 4,000 kilometre long cable, and export Australian solar power to Singapore. And I just wondered if the panel thought that this was a real credible project, or whether it was a publicity stunt that would garner a lot of nice coverage for its backers, and perhaps some government subsidies, or is it something that's real and likely to happen?
Jeez, thank you, Daniel. Not sure who wants to take that question.
I can maybe start off with that one. I mean, I started writing about this last year, and it just seems like crazy, really. When it first came up, it just seemed like impossible. Always the problem with long distance cables, and I'm sure that CEFC speaker is going to be much more au fait than I am on this. But the problem with long cables has been that they've never been. There's so much energy loss in that process that there's just it's hard to make a business case for it. But when you think about the huge solar resource, this is going to be a massive solar farm near Tennant Creek, supported by quite a bit of storage, as I understand, both at Tennant Creek and in Darwin. Look, you talk to the Sun Cable people now, and that it's got, because of advances in technology and the types of cables that can be used, the feeling is that this is a real technical possibility now. I think there's still some question mark, though, around whether a cable is actually the best way of doing it, or whether it's through hydrogen exports. Because if you think about it, it's just a method of delivery. A hydrogen exports by ship or whatever is a method of delivering solar power to Asia effectively, and a cable is as well. So it's just so this debate around what actually is going to turn out to be the most economic way of doing that, whether spending billions of dollars on a fixed cable that goes from one fixed point to another fixed point is the best way of doing it, or whether something with the flexibility of hydrogen exports by tanker will turn out to be the best way. It's like gas pipeline versus LNG. So yeah.
Bob, probably I'll give you the last word there.
Okay, thanks, Hans. Great points, Angela, and I think you stole my thunder in terms of sort of approach to sort of looking at things. And look, electrical losses associated with the lines will be a key factor. Diligence around what happens if the line were to go down, and the ability to maintain and ensure that the availability of the line is as close to 100% as possible will be one of the key sort of banking considerations associated with the project. But much like with, for example, offshore wind or whether it be, for example, large-scale renewable projects, in terms of in the context of, for example, RESs, where we're talking, multi-gigawatt sized projects, there is always skepticism in terms of the ability to deliver, given that they do take a number of years to come to fruition. In terms of the prospects of this particular project, I think it really comes down to understanding what level of support the Singapore government has to be able to underpin the demand for the project. I guess not knowing too much about the project, Australia, if you look at the geographics, strong resource in terms of solar, heaps of land, whereas Singapore is quite constrained. So if they do have ambitious targets, and this project is a means to be able to help fulfill that, then it seems like it's worth at least progressing and further testing. In terms of the fundamental economics, it's too early to say.
All right, cheers. Thank you, Bobby, and thank you, Daniel. I'll end it there today. We're 1 minute away from past. Thank you very, very much for everyone that's chimed in today and tuned in today. And thank you very much to our panelists once again, Angela, Andrew, and Bobby. This is our last webinar as part of our Grounded series. So thank you for everyone that's come to more than one, and there's probably quite a few who've come to all four, which is brilliant to see. Brilliant to see. Just a little plug. The Monash Energy Club. We had a couple comments that people want to know a little bit more about it. So the Monash Energy Club, just as a brief, is a student-run club at Monash University, and we're trying to get more people engaged in the energy industry from careers that are not just in the engineering faculties. So obviously engineering is a hugely important part of the energy industry, but as you can see today, is a huge economic and is a huge journalistic scope on the energy industry as well. And we're trying to really draw attention to those sides of energy and try and get more people from Monash University, from those faculties, into the energy industry. And of course, we're also big focusing on the transitioning energy industry, which is probably one of the most interesting topics in the industry for quite a while. So I'll put the link in the chat. That's our website. You can also follow us on Facebook, Instagram, Twitter. And you can become a member and keep in touch with all the events we've got coming up. We've got quite a few coming up. We've got a masterclass on hydrogen, pretty topical from today, with Net Zero and Climate Works. And then after that, we've got a hackathon. So you'll be given a number of problems, and you'll be asked to solve them with some prizes at the end. So that's the end of it today. Thank you once again for everyone who came and for all the great questions that you asked. And good luck and stay safe.
Thanks, Alex. Well done.
Thank you.